Hi, thanks so much for tuning in. You're watching BQ Prime. Now, in life, when you have to go somewhere, if you have a destination in mind, there are several ways in which you can get to that destination. And you will find a lot of people that will argue for one particular route that you can take, but there are several routes that you can, in fact, take. There are pros and cons to each of those routes. Just like that, in investing, there are several strategies that you can employ to reach a particular goal or destination. We're here today to talk about one such strategy, the value strategy. Now, we'll break this up into two parts. The first one, we'll be talking about a value fund at one particular AMC. And in fact, let me introduce you to my first guest. I've got Suresh Soni, the Chief Executive Officer of Baroda BNP Paribas Asset Management, joining in. And thank you so much, Suresh, for taking the time, and pleasure having you on the show. Let me start by asking about the value fund that you have just launched. What is the strategy? What category does it play in? And why did you decide to launch the fund?
Thank you, Alex, and delighted to be here and talking to the viewers through you. You very rightly said that there are multiple ways of reaching a destination, more so in the investing world. There are deterministic signs and then there are probabilistic signs, and investing falls into the probabilistic signs. Value investing is essentially about buying something at a price lower than its intrinsic worth. So that's the basic fundamental premise of it. Now, why would you get these opportunities? At what level do you get these opportunities? That's where we want to discuss a little bit. So essentially, the value happens because there could be times when a stock, sector, market segment, or the entire market could be out of favor from investors' radar. And therefore, the value opportunities can emerge either at the entire market level, which is something that you saw post-Lehman or let's say post-COVID. It could happen at certain market segments where you find that there are times when mid-cap or the small-cap segment can either be too cheap or can be too overheated. That's something that we have experienced. Or it can happen at sector level where there are certain sectors which are completely ignored by the market. And finally, at stock level. These are the opportunities which offer you essentially buying stocks or buying good companies at relatively reasonable valuations. And the belief is that if you happen to buy them at valuations which are lower than their long-term averages or are lower than their growth potential, then you not only benefit from the growth of the business, but you also benefit from re-rating.
Understood. Now, I want to make a distinction here because there are fund houses that espouse the value strategy, and that is reflective in the active management of several schemes across the board. This particular scheme is a dedicated value fund. So therefore, the strategy that is implicit in that is a value strategy. How does this gel with the strategy that you as a fund house espouse when you're managing active funds?
Yeah. So very good questions. See, as a fund house, when we are investing, we are obviously looking at companies which have potential to grow and generate wealth over a period of time. In the value fund, you use a few additional screeners where you focus a little more towards the valuations of the companies. Let me give you an example. You know, the difference between, let's say, buying a value stock versus buying a pure growth stock is essentially a growth stock does factor in a continuing growth momentum of a company, whereas in a value stock, you're essentially looking at some changes in the company or some changes to occur in order to unlock that value. And those are the two differences between the approaches per se.
Okay.
So overall, I think the finding a value is just the starting point. Then you wait towards understanding as to why is the stock trading where it is trading and what would unlock that value in future.
So, but as a fund house, you have both strategies that you espouse, right?
As a fund house, we indeed espouse both the strategy. There are funds that are managed on the growth strategy, growth at reasonable price, and then there are one which are focused on value. And this is the one where we are focusing on value. And indeed, there will be a distinction in the way we run this fund versus the other funds.
Okay. Now, when it comes to value, especially if you go by the words of very well-known value investors the world over, time spent holding an investment seems to be particularly key, beyond just identifying that a stock is valuable at a certain level. Now, what according to you is the difference between that holding period when it comes to value versus growth, and what according to you should an investor bear in mind if they are looking forward to investing in this fund or in this category?
So in terms of time horizon, in growth, you are already talking about the companies which are tracked by the market, which are very well, let's say, established in their area, and therefore have a growth momentum behind them. Whereas in case of value, you look for opportunities which may be out of favor. You know they are good investment, but you just don't know how quickly would they be recognized by the market. And therefore, I would recommend investors a time horizon of at least 3 years for investing in these kind of funds, because value in terms of the cycle to play out does take a certain amount of time.
Okay, fair enough. Suresh, the other aspect, of course, is the selection of stocks. And I understand you can't get into details of portfolio, but what can you tell us about the construction? Because if I look at the market right now, or if I look at a market on an ongoing basis, the general thesis is that you will likely find more value at the smaller end of the spectrum when you're talking about market capitalization rather than the larger end of the spectrum. Could we then anticipate that the portfolio will have a tilt towards the smaller market cap or the middle end of the market?
I would say we have a flexi cap approach.
Sure.
So we'll go up, straddle all the segments of the market. And, it's wrong to say that we'll be able to find value only in the small cap. I mean, all of us are very familiar that there were memes floating around of some of the large cap companies just not so far back. And therefore, the value does occur at all the places in the market, whether it's small cap, mid cap, or large cap.
Incidentally, the stock that you just spoke about hit 52-week high just this week.
Absolutely.
Right.
Absolutely. So, indeed, the market tends to sometimes overreact on either sides. And there are opportunities which are available across the market cap.
Finally, what are the pitfalls that one should bear in mind? Because there is a tendency to mistake value for a change in the cycle when it comes to a sector or stock. Is that a major pitfall that you think will have to be tackled?
So a couple of things. I think, first of all, just because something is cheap cannot be called value. There has to be a way or a reason why would it be valued properly by the market? Why will it become valuable from being valued? So you need to have one understanding of why it is trading, where it is trading, and secondly, thesis for unlocking. Secondly, you just don't buy low PE, particularly in case of cyclical sectors. In fact, more often than not, you actually sell them at the peak of the earning when the PE ratio appears to be low. And you, on the contrary, buy them when their industry is going through a tough phase. But at the same time, you know that these are the companies which are going to survive. Seemingly, the PE ratio may appear higher, but that's at the bottom of the cycle, and therefore you have a much more constructive way.
Understood.
So it is not only price-earning ratio. You look for the valuation parameter which is relevant to that particular sector, that particular industry, and then go deeper into what is leading to the current undervaluation, and finally, what would lead to unlocking of the value eventually.
Suresh, Soni, thank you so much for taking the time and for helping us understand how your fund approaches this particular scheme category, and wish you all the best.
Thank you so very much. Delight talking to you.
All right, so that was the Chief Executive Officer of Baroda BNP Paribas Asset Management. And now you have a fair idea of the value fund and the category of mutual fund scheme. But let's talk about whether or not it makes sense for you as the investor to choose to invest in this particular category. Joining me to talk about that is Kshitiz Mahajan, who is Managing Partner and Chief Executive Officer of Complete Circle Wealth Solutions, and Nikhil Kothari, who is Director at Etica Wealth. Thank you so much, gentlemen, for taking the time and for speaking to us on the Mutual Fund Show. Now, I will go to you first, Kshitiz, and I'll get both your opinions on this. What do you think about the value fund category, first of all?
So, Alex, first of all, thank you for having me on your show. And as we say, there are different baskets of funds which have been offered by our mutual fund portfolios industry, and value is one of the investing approach, which normally is of a theme that they will buy into companies which are trading less than their intrinsic value, or let's say where you see that they are not getting the due price which they deserve, the companies which they are buying in the portfolio. So many cases we have seen most of the strategies are growth oriented, where we buy into those companies which are very high on growth, and where we see the growth coming, which are at high valuations also, but you don't mind buying those companies because you expect the growth to be compensating those high valuations. But value theme, you see that companies are doing fine, but for XYZ reason, it can be these stocks are cyclical stocks, sectoral approaches there, or let's say for some reason they are not getting, let's say some news is around the corner. Let's take, for example, HDFC Bank, HDFC Limited, the merger is about to happen, or it can be any other reason also that they are not getting the right price. So they are trading below their intrinsic value, which is the real value which one can expect to give to these stocks. So when you combine those stocks in a basket and make a fund, that's how we call a value approach strategy. So I think it's a very good complementing strategy to the growth strategy, and that's how this approach has been carved out almost 15-16 years back by a mutual fund house, and many of the AMCs are offering value thematic mutual funds.
Okay. So initial thoughts, Nikhil, would you like to complement what Kshitiz had said?
Yeah. So in a portfolio, I'm saying when you're devising a portfolio, right, you need to have scheme across different categories and across different styles, right? Because that's what diversification lead to. If you have two funds which are both following a growth style, then ideally there's not too much of diversification. Right. So when you're constructing a portfolio, one should look at different categories of fund in terms of one can be large cap fund, one can be mid cap, and one can be small cap. In that also, you can follow. There are three predominantly style. One is growth at any cost. There's one at growth at reasonable price, and there's one value. So out of these three categories, one can have a portfolio that one can look at growth funds and some at value fund. I'll always say that in one category in a one portfolio, one should always have a value or a fund in their portfolio, because they normally take longer time frame to perform. But whenever the cycle turns, right, they can give you outlier return. So and over a period of time, sometimes growth will play out and sometimes value will play out. Like in last 2-3 years is on more of a value cycle which is played out as compared to growth. So in that case, the client portfolio is well diversified and the average returns are taken care from that perspective.
That's a very important point that you're making. They don't necessarily move in tandem. But Kshitiz, when you're talking about value fund per se, it's in the name, right? It is a fund category that espouses the value strategy, and you've described what that means. But there are fund houses that have this strategy inbuilt in the active funds that they operate. So should you go for a scheme that is specifically value, or should you have a wider approach? Say, a fund house ABC that espouses this value strategy, would it be better to go to that fund house or that mutual fund scheme?
Alex, so look, on an average, we have 4 to 5 schemes which we recommend a client should have in his portfolio, else than your ELSS and other, let's say, if you are having a sectoral buy in your portfolio, you want to have a pharma or healthcare or let's say IT fund. But you asked me, I will like to keep it simple. I will like to have one for a new investor, an index fund, couple of focus or multi-cap fund, one larger mid-cap fund or a mid-cap fund, depending on risk appetite, mid or small cap fund, complementing it with a value fund. So that's what I feel. But yes, there are fund houses which offers you a mix of strategies also, wherein you have a value as well as you have growth on these stocks. Just to make everyone, just to make this entire mood little light, you'll be surprised that many of the growth stocks have become value of late, especially IT stocks. Now, Infosys is as good as like a value buy right now at these levels, because it's trading at 13,000-14,000 Nifty level, where Nifty is at 18,000 level. HDFC Bank is a value buy as on date because the merger is about to happen. ITC a year back was a value buy, irrespective of it's a growth-oriented company. So, from where I'm coming, normally, my fellow colleague has explained it beautifully that sometimes some strategy will play out, sometimes some strategy will play out. But if you actually want to have the real essence of that value play, then one should have a pure value fund. And it should be a part of anybody's portfolio, because yes, both the strategy will not go in one tandem, but at the same time, when the cycle will turn, it will play out really well for clients. And cycles have shortened. Earlier, for any sector also, for let's say a commodity also, we used to have a long drawn cycle, 6 years, 7 years, 8 years. The cycles have also shortened. It's like the way our screen time has shortened, the way our screens have shortened. Equity cycles, commodity cycles have also shortened. We want seeing 7-8 year cycles. So my submission here is one should have a pure value fund in the portfolio, and which can and believe me, I've been analyzing all the focus fund, multi-cap fund, value fund. On an average, you see 5-6 year return is in same line between 13 to 15% compounding only. It's not that somebody has given some exceptional return, but it complements you the overall portfolio return when your growth strategy is not doing good.
Yeah.
So that's how approach this entire portfolio approach.
So overall, I think it evens things out, is what you're pointing out, right?
Yes.
So, but I will go to you, Nikhil, on this next one. You've already mentioned that this is something that takes a slightly longer time to play out, just by the nature of this, because you're ultimately trying to buy low and sell high. But then what are the pitfalls associated with this? And I'll come back to you, Kshitiz, also on this. When you're selecting the right value fund, you need to understand the strategy and the strike rate, right? Because that is important. Nikhil, how important is that strike rate for an asset manager to hit on a consistent basis?
So see, the biggest problem in value fund, I'm saying it's very simple, that you buy something at low price, okay, and then you sell at a higher price. I'm saying on the face of it looks very easy game, right? But the biggest problem in value fund is the value trap. You may see that, okay, this company has a good value, okay, the price is low. And when the prices are low, when the things are, when there are headwinds in that industry or in the company, right? Either there's some problem in the profit and loss account, or there may be some problem in the industry as such in terms of the growth of that industry. So there will be some problem at that point of time, which has made sure that the prices come low, and that's why the stock or the industry is in value. But whether it will turn out or not, okay, whether the management, or if there's a problem with management, whether the problem will be solved or not, or whether the industry headwind will be solved or not. So if that is not done, then it can fall into a value trap. And you may keep on buying that stock or keep on averaging the stock, but the stock can keep on going down because it's a value trap. So fund has to be very clear that when they're buying a value stock, they don't fall in the value trap. Okay. And the second problem in this category of fund is that they can be severe underperformance for a very long period of time as compared to index. So most of the investors, when they compare their portfolio, they will say, okay, the index is giving me X percentage, this fund is giving me Y percentage. Now the period of underperformance can prolong for 2 years, 3 years. And that time, investor gets impatient and they sell this fund. And that can be I'm saying the peak point when the main point of the fund can revive. So when investors investing in this fund, they have to understand that there can be a long period of underperformance as compared to index. Okay, and the fund has to be very careful in terms of identifying stock which are not a value trap, but which are actually a value stock, and then they can revive if the industry headwind changes. And if those things are taken in place, then over a medium-term period, the individual can expect a good return on this portfolio.
Fantastic.
Now, when you're selecting a fund, there are a few fund houses which are more biased towards value, and there are a few fund houses which are more biased towards growth. So if you're selecting a fund, you can say that, okay, this fund house follows a value style in their investment. And if I want to go and select a fund, I can go and select a fund from that fund house itself, their specific value fund. So you are because the fund house follows a value strategy and for buying a value fund.
Understood. Okay. But interestingly, Kshitiz, you pointed out Infosys, and I think the story for Tata Motors was similar when it slipped below that 100 mark.
Yes.
And, that's a perfect example for a growth company becoming value at some point. But again, what Nikhil was pointing out was that there would be likely long periods of underperformance because my stock selection may not be similar to somebody else that is employing a value strategy. So how do you select that stock? And should you be okay with long periods, 2-3 year periods, where you're significantly underperforming not just the index, but also peers?
So Alex, that's why you see a fund approach is always better vis-a-vis selecting individual stocks. That's why we say mutual fund. And in mutual fund, all the value good funds which are doing fairly decent over a period of time and where drawdowns are not that big, you have seen there is a good mix of PSU as well as private limited companies. PSUs, as said by Nikhil, has a long gestation sometime. You have seen the entire banking system has gone through overhaul change, and because of NCLT, we have a lot of recoveries coming. Banking system is getting better. It has taken a lot of time for, except for SBI, to come up the curve and perform. So similarly with other PSU companies also. Vis-a-vis the private value companies will not take that time as a long gestation time. Sometimes it happens, some holding company has some news coming in. Let's say Sundam Gladden is one example. Again, whatever we are quoting here is not a recommendation.
Yeah.
There was some news dividend side, preferred share side on the Sundam Gladden side. Now that has to play out till next March. And then we'll see that whether that was a value buy, that was the right choice. It's a news-based buy or not. So, a fund manager while selecting, because we keep on interacting with all the key guys, the fund which we manage for our portfolio, the suggest for our portfolios, that how they are looking at the portfolios. And what I can get from them or I can draw from them is that they get into a larger number of chunk of stocks. Let's say some will have 60 stocks, 70 stocks in their portfolio. Somebody will have more than 70 stocks in their portfolio. Because if there is a chance or risk of a value trap, then the risk should be less on the portfolio level. No? Right. One of the fund has almost 20 plus stocks, which is less than 1%. So that the overall dent to the portfolio should be less if it's a value trap. And very well said by Nikhil that yes, value trap can be one of the cases where you can fall into that and you just see that portfolio is going nowhere. So I think it's a good mix of PSU and private limited companies. At the same time, as you pointed out, Alex, many companies which were growth companies because of some news, XYZ news, whether it's COVID or some industry specific news or what happened to IT sector or pharma sector, has now become a value companies.
Right.
Index at 18,700 years back in October 2021 was at 27 trailing P. Today is at 21 trailing P. So the difference is, so index, if you keep this index, and I'm not saying that it will remain at the same level for next 2 years, will become a value index in next 2 years time. If you will see the earning growing at 12-13% also. So we have to understand that portfolio approach is always better. And I will love to go with a couple of value funds for clients, wherein I see there's a well diversification is there, and there's an active management is there, and a good combo of PSU and private limited companies are there.
So why don't we get those names so that our viewers have something to take as well from this conversation? Nikhil, first, if you can identify a few funds that you like, and then we'll go to Kshitiz.
So basically, as I said earlier, that we normally prefer when you're buying a value fund, the fund houses also to some extent follows a value strategy. Like from IC's Shankar is known for that. He can identify sectors which are underperforming now, which can revive, or which he normally takes a contra bet many times. So when you're investing in value fund, we normally prefer Temple India value fund or a ICC value fund. And over and above that, Invesco in contra follows a very specific strategy where they have a very clear band in terms of every stock is classified as either growth or a value. And they have, in contra fund, they have most of the funds, stocks from that value category. So these are three funds we normally prefer when it's coming to value or contra investing.
Fantastic. Kshitiz?
So, one of the fund I like what Nikhil is saying is Invesco Contra. Tahir, who's the CIO, managing himself this strategy. And, if you actually look at the top holding also, HDFC Bank, Infosys, ICICI Bank, Reliance. So if you actually see all these top holdings for this fund right now, they were a growth, stocks almost a year and a half back, which has become now value because prices are not moved up that much. Or let's say it's corrected from its peak. So I think that's one of the strategy which has been consistent in its endeavor and very well diversified. I was taking example of companies which are less than 1% is more than 20 companies is Invesco Contra only. Again, there is no recommendation. These are just funds which we like. Second is which strategy I like the most is SBI Contra. And again, one of the key strategies in value play, which is banking very high on financials, which is banking very high on consumption, consumer staples, is doing really well. So that's another strategy which is doing well and very consistent in its approach also. So last 1.5 3 years has been for value play, which we've seen 2020 once market started recovering. There's a lot of infusion of capital, growth started working, and then growth value started playing. But when an investor is investing, he is not investing for a year or two.
Yes.
But a consistent approach toward both the strategies will help him to have a balance, or let's say a less drawdown on overall portfolio,
Very
because
important.
both the strategies complement each other, and that's the crux of story. Because as a what should I say, as a news channel, BQ, or as Kshitiz or Nikhil, as industry expert or advisor, or as a client, what we want to give investor is experience where the drawdowns are less. Try to do that, where we can suggest that he can complement his portfolio by adding value to overall growth strategy.
No, very important points. Gentlemen, thank you so much. And I think the takeaway for me is that you use this value fund as a part of a whole to diversify the strategies that you employ as well. There could be lumpiness in the performance of this particular category because of the implicit strategy that they're employing. And so patience is key. But thank you so much, gentlemen, for taking the time and for taking our viewers through this very important category. Viewers, do stay tuned. Lots more coming up over the course of the day. And this is BQ Prime.